Investing at the polls right now is super hot. I woke up and we had 6 bookings over $7,000 and I was addicted. People look at this as a real estate business and it's not. It's an operations business wrapped around a piece of real estate. We made 80 grand, took home about 22 or 24 grand that first year in free cash flow. Now I'm paying myself instead of paying the US government. I got a 30% plus return on day one. It became this really good learning experience that really got me started in the real estate game.
Why are STRs so sexy when they seem so unsexy from the outside? Taylor Jones, personally, I'm really excited for this because I want to learn about this topic, which is short-term rentals, Airbnb, vacation rentals, VRBO, whatever you want to call it. And I have the man, the myth, the legend, Taylor Jones, who is the founder of STRsearch.com. He's also raised a couple of funds. Taylor has overseen over 200 STR investments, over $120 million of deployed capital. So the dude knows what he's talking about. I want to ask you this first question. Why are STRs so sexy when they seem so unsexy from the outside?
Yeah, it's kind of interesting. People look at this as a real estate business and it's not. It's an operations business wrapped around a piece of real estate. So, what you're getting into is where art and data come together. If this was just purely a data investment, you're really looking at long-term rentals, multifamily, all the other boring stuff that's very straightforward. Where you can kind of get those outsized returns and that little extra that attracts people to this asset class is the art form. Understanding how much extra revenue does a swimming pool add in this market versus not having one? What about a pickleball court? What about a lazy river? What about the size of your deck on the back when you go outside the patio? These are the little nuances that really coincide with how much you could charge on a nightly rate, how much excess revenue you can achieve amongst your competition, and ultimately how much more money you can make than a standard investment.
And that part's really interesting because I think a lot of people look at it as a passive income stream. Just hearing what you just said, it's like, if you get into it thinking it's a passive income stream and you're competing against guys like Taylor Jones, you're going to get your lunch eaten. like you're looking at, hold on, how many square feet of pool do I need to add in order to raise rent by 32%? Oh, okay. Like you said, it's an operations business wrapped in real estate. It's not a real estate passive income. And maybe that's just my own observation, but would you say that's a fair observation of people who get into the space?
It's very fair. And you don't know what you don't know if you're just kind of really taking this as a passive approach. So for example, if I'm going to go into the Phoenix Scottsdale market, I will not buy a piece of real estate that doesn't have room to install a pickleball court if there's one already there. So your next question is, well, how big of a yard do you need? And I tell you, well, the playing dimensions are 22 by 44, plus you need a minimum 3 feet of excess. So I'm going to go use Google Satellite and measure, can I get a 28 by 48 minimum? Obviously, you can make the serving lanes bigger and add more concrete if you have the space. But these are the kind of things I'm going to instantly look for. So I'm not even going to look at the inside. The very first thing, if I'm going to potentially buy in the Phoenix Scottsdale market, for example, I'm going to go straight to the backyard, go straight to Google Satellite and measure, can I get 28 by 48 in the backyard? If the answer is no, I don't care if the inside of the house has Carrera freaking marble. I'm not buying it. It's not worth it because the ROI on a pickleball court versus not in that market is over $40,000 in revenue difference. So it just doesn't make sense to run an Airbnb without one when you get such an insane premium to have one in that market.
How did you start out in this? So I've had businesses and I've just always loved the idea of having real estate and having rental properties because I guess that's just what you do to build long-term wealth. How did you get into it? What was your first property?
Yeah, so lifelong sales guy. I was always chasing commission, 7-8 different sales jobs over about a decade. COVID hit at a client-facing sales job. And, I wasn't fired, but I wasn't allowed to go sign new contracts. And so you're kind of in that tough spot. And the one blessing I had in March and April was I had all the time in the world. Naturally, like a lot of people had a niche for real estate. And I was like, cool, I'm going to go consume a bunch of YouTube videos, podcasts, bigger pockets. I'm going to read everything I can. And so I spent all my waking moments instead of working, diving in, learning real estate. And I looked at everything. Should I go into wholesaling, broker, flipping, Section 8, long-term rentals? I looked at everything and then naturally came across short-term rentals. And, me and my wife, we've stayed in 27 different Airbnbs since 2015. So I've been a consumer of the product, but I never looked at the unit economics from the host side. Wish I did back in 2015. That'd be a different discussion. But I started looking at it. I was like, oh my gosh, there's a lot of opportunity here. And, started diving in, really niche down on that topic, spent about 2-3 months. And I'm kind of one of the guys that I don't want to get analysis paralysis. Too many people get that in, both in business investing and real estate. You can study, but I always say at some point you got to jump in the pool You don't have to be Michael Phelps on the first day. You just got to know enough not to drown. And so after about 3 months and writing 5 different offers, me and the wife, we got our first cabin in the North Georgia mountains under contract. Flew up to Atlanta, went up there for the inspection. The inspector was like, hey man, like a couple small things. It's real estate. There's always small issues in the inspection, but he's like, overall, man, it's a pretty solid cabin. I was like, sweet. Flew home back here to Florida, back up there for the closing. And then we did a bunch of sweat equity, new game room, install a fire pit, air hockey table, painted, new furniture, and then turn around and, listed it on Airbnb. And eventually the job came back. So, Florida was one of the earlier states to open up. So I'm starting back working.
Hold on, before you move on from that, had you bought real estate before?
No, first piece of
This is
real
your first piece of real estate, and you go up there and the inspector's like, oh, there's little minor things, but you should be good to go. So you buy it, you do a bunch of, I guess, renovations. How much money did you put into it?
About 40 grand into it. Yeah, about 42 grand into it.
How much did you put down to buy it?
So we did a 10% down vacation home loan. So the property was 460 grand. So, about 46 grand plus closing costs. So it was a little over 100 G's, with furniture. The sweat equity would help. Obviously, if I had to outsource that tab would run up a little bit more, but the sweat equity helps for sure.
Okay. All right. So you put in 100 grand. What was the monthly nut on that? Like, what were you paying in mortgage?
It was probably around 1800. Interest rates were lower. So it's 5 years ago. So that was always very net beneficial. And the appreciation run up hadn't happened of COVID yet. So yeah, that was, it was about 1800 a month there on that one.
You've got this little cabin, North Georgia, put $100,000 into it, $1,600 a month of a mortgage on top of it. Things are starting to open back up. All right. I cut you off. Keep going.
So I remember we get this thing launched. It was a Tuesday night. And I was like, okay, like here it is. Like you got your listing. And I've seen, we've booked Airbnbs and I was like, okay, like I think I know what it looks like. There's obviously not as much resources as there is today. I remember I woke up and we had 6 bookings for, over 7 grand. And I was addicted. I was like, oh my gosh, this is great. So that
overnight?
was, yeah. So you launched it, again, and you just kind of sit and, the good thing about Airbnb is they do want to help new hosts. And so for your first 30 days, you get kind of a lot of free promotion. They shove you up on the first page and it's in their best interest because if you don't succeed, you're going to quit the platform and now they have an inventory problem. So naturally, they're going to give you artificial boosts in the first 30 days. And they're going to see like, hey, do people find your listing attractive? Because if they do, then they know, hey, we need to keep this near the top. If you get 30 days of free promotion and no one's booking your place, that's a signal to the algorithms on Airbnb and Vrbo is like, hey, this listing sucks. No one wants it. And so it's going to move it down to page 5, 6, 7, 8, et cetera, and you'll get buried. So if you come out of the gate with good photos, good amenities, good design, and your place looks good and you get bookings, that's telling the algorithm, hey, this is good because let's not be naive. Airbnb makes money when you make money. On every booking, it doesn't cost anything to list on the platform. So if you don't get bookings, they don't make money. So they want to incentivize, well, which properties are getting a lot of bookings? Let's push those near the top because we make money too. Yeah, man, 6 new bookings came in. Obviously they were spread out for, some allotment into the future, but seeing that money there, that 7 grand, I was addicted.
Obviously it's probably different today than it was back then, but I'm curious from your perspective, what did you do right with that first flip? Not first flip, but first property. And what did you do wrong?
Okay. So what I did right was buy in a high demand market. So North Georgia, you're an hour and a half from Atlanta. I didn't have the data again. Like I kind of, I got lucky, but I didn't get lucky. I picked somewhere that I like to go. So as a Floridian, if we want to escape the heat and we get in our car and drive north, the first mountain range you hit is the North Georgia mountains. So I knew, hey, a lot of Floridians go here and Atlanta's an hour and a half away.
It was anecdotal market research, but it wasn't data-driven market research.
Exactly. Obviously, where things are today versus 5 years ago, completely different animal. But, it was kind of that directional. So kind of what I got right was it was in a high demand market, it's desirable, and, nailed that part. What I got wrong was I ultimately didn't buy the right product to succeed long term. I bought a 3-bed that stared at the trees. And that ended up being the most common supply in that market. And so when you have a ton of excess 3 beds that stare at the trees, it becomes a race to the bottom on price for what you could charge.
In that first year, how much revenue did you generate from that one property?
We made 80 grand. And after mortgages, expenses, utilities, cleaning, hot tub supplies, all that good stuff, we took home about 22 or 24 grand that first year in free cash flow. So it was like, great.
Wow.
Got your feet wet. And this was
that better?
A really good,
better than you expected? Worse than you expected?
I don't know that I really had a ton of expectations of like what it is. I think it was so cool back then and it was like this newer thing. There wasn't these huge million follower influencers that promoted the
Right.
space. It wasn't really there. And so I didn't really quite know what to expect. And so to me, I think just making money was the objective. And then someone tells you about tax benefits and other things you can unlock from real estate besides cash flow. And it became this really good learning experience that really got me started in the real estate game.
When did you realize like, oh, this could be something I could go all in on? This isn't just like a cool side hustle.
Well, 4 months later, I bought another cabin in North Georgia. So as soon as I got addicted, I said, okay, let's go stack and get more.
How were you buying those? Because you said your sales job is like you weren't allowed to sign new clients. Like, how did you have the cash to go buy another cabin?
Had a little bit staffed on the second one, ended up going 50-50 with another one of the sales guys. So was like, hey, dude, and he had a piece of real estate and we were like, okay, cool, let's go in together. So yeah, didn't have enough cash to do that one myself, but ultimately said, hey, let's go 50-50. So we split, put up half the money and rolled into that second one. Again, you took your wins and your compounds and you just rolled them into that second one. We bought a better product. This one had a mountain view. So it was on top of the mountain instead of the wooded lot. It was still also only a 3-bed, which is kind of the most common supply in a lot of markets just because it's the easiest thing to build. Most builders aren't going to go build small couples getaway 1s and 2s that are 600 square feet. And most builders aren't going to build 5, 6, 7, mansions. So you get a ton of those 2, 3, 4-bed, it's just the most common product. And what you've seen over the last 5 years is that middle of the market has really been frothy because there's just so much supply of it. And so really investing at the poles has where your opportunity has come.
So what's interesting is, let's say for these two properties, you're what, in $120,000, $150,000?
Yeah. So second one was slightly bigger. So my half on that second one was another about 80 grand. So we bought a slightly bigger place, slightly bigger amenities, so that one would have been about 160, some more sweat equity. We both went up there with both of our spouses. So 4 people doing hands-on labor to cut costs. But yeah, it was just continuing to compound.
And then that one, how much free cash flow did that one generate?
That one spit out 48 grand, of which my half was, about 2 G's a month on that one as well.
Okay. So for the first year, what I'm trying to get at is like $180,000 in, and in free cash flows, like cash to you, let's call it $45,000. That's a pretty good cash on cash return, but you get kind of capped really quickly, right? Like you were tapped out at that point. You were done. Like you didn't have any more cash to redeploy. Were you thinking, cool, this will be long-term, I'll build some more equity and then I'll cash out refi and then we could buy another property? Or were you just so hooked that you thought, but when can I get my next hit? I need my fix. Like when am I get my next property?
It's kind of crazy. You start talking about it and other people kind of lead you into like, I didn't even know you could raise money. And then I had uncles who worked for Oracle and other jobs and they're like, hey man, I want in on the next one because they hear about how great it is. And they're like, hey, I'm in for 100 grand on the next one. Hey, I'll give you 75 grand. And so like, realize like I'm personally tapped out at this point. I got to recycle cash. I got to work more, save for my W-2, my sales job, kind of stock cash on commissions, stock the cash flow. But that's going to take, another year, 2 years to kind of restock the farm to be able to go buy a third. But like, hey, these people are offering me 75, 100, 120 grand. And they're like, they want in on the next one. And then you just go down this rabbit hole of like, oh my gosh, like you could raise money. That just kind of opens and unlocks an entirely different skew. And it's really fascinating how quickly 1 becomes 2 and 2 becomes 5 in this, very quick.
Especially once you go and raise money. So I'm going to put the raising money to the side for a second. I'm most interested in kind of how, as an entrepreneur, you could actually go and get into this space. 2020 was an incredible time. It was a beautiful time. Lots of money, rates were low, property values hadn't gone nuts. And so when you buy those first few short-term rentals that you have, probably get in at a good basis because the rates are low, your mortgage payment is low, and there wasn't as much competition. Your rates that you could charge other people was good. Let's fast forward like 2 or 3 years. Where are they now? Like, are they still great? Or is it still, would you say it's like, it's okay, I'm breaking even? Like, how is the short-term rental market looking now?
Yeah. So personally with those two, I've sold those and 1031'd into more ideal products because after you sit there, you realize, hey, this isn't an ideal product to own. Good news, had equity, so cash that out.
Okay. Then forget my question. I want to drill in on that. What did you learn that you did right, and what did you learn that you did wrong with those first 2 properties?
being able to have some sort of a moat. So that second one had the mountain view. It was on top, and it was, okay, it's so much easier, and I'm able to command such a premium. They were both 3-bedroom cabins in the same exact market, but one of them was making significantly more. We were talking to the tune of about 40, 50 grand more in top line revenue on an annual basis than the other. And so when you have something that is hard to differentiate, again, a 3-2 that stares at the trees in the woods, that's the entire mountains. And how are you going to differentiate? And it becomes a race to the bottom. So what I learned from that is, if you're going to go into this, what is a differentiator for that market? And that could mean a lot of different things. It could be close to the beach. It could be riverfront. It could be straight location. It could be the features. Is it modern? Is it a tree house? Is it a yurt? Is it like, how can you be different than your competition? Because it's going to give you some sort of an advantage that you don't have to worry about, oh my gosh, I can't differentiate my property amongst guests on the platform.
Interesting, because otherwise it becomes commoditized and then you're just competing on price. Then it's just a race to the bottom. You have to have something that differentiates enough to get people to pay more for your location.
100%. And I think that applies to all business across the stack. It's not as difficult for putting in systems, as it may seem on the outside. I think that's the toughest thing people think is, hey, and what automations and systems and tech that there was 5 years ago versus 3 years ago versus today is absolutely wild. I think like any industry, it's continued to grow. Obviously, all the buzzwords, AI, getting mixed in here to the asset class. Obviously, it hasn't been as adaptive as I would say other industries, because there is some limitations to hospitality, but you're starting to see it become more systematized, more automated on the back end, so that you can run these and not have to be local. Again, like I don't live in North Georgia. In fact, I live not even in the state of Georgia. So you can put in systems, have local boots on the ground help, a la contractors, a la cleaners, who can go in and execute. And you really kind of systematize this as a business. And I think if you treat this as its own little business and not just as this passive endeavor, as we talked about on the onset here, that's where you can get strategic advantages. Because like anything, if you treat this as a dip in the toe with any business you do, any endeavor, you're going to kind of get the results of dipping your toe in. And I think if you treat this professionally, you can get professional results.
So you found cleaners, you found, let's call it handymen, repairmen, plumbers, people pretty easily for that area in North Georgia?
Yeah, a lot of Facebook groups, a lot of asking around. And now it's gotten even crazier. There's entire marketplaces of Airbnb cleaners where you can put in any city in the country and you'll get a whole list of them and you can start cold calling. So it's just, that's the evolution of this asset class, which is incredible.
Okay, so what did you do wrong? Like looking back, you're like, man, I'm so freaking lucky because I did this and this wrong.
I thought the gravy train would continue to go forever, and had a chance to sell for about 100 grand more than we did. So that second cabin, bought it for 640. And in the peak of the market, I mean, we're talking 0% interest rates. Everything was super frothy. And I think like a lot of people, I got caught up. It was like, man, the gravy train's going to keep rolling. We had a chance to sell for 1.025 in 22 months of ownership. And was like, nah, let's just keep it going. Let's keep it going. And then reality kicked in and you're like, oh yeah, this was like La La Land we were living in, and ultimately still had, appreciation, and we sold it for 920. So don't get me wrong, like still a very good return on the onset. But when you look back, I think the biggest mistake was I need to take a step back. Like sometimes when things are almost too good to be true, when business is cooking, the general economy, the market, that there is such a thing as a downturn. I think to me, like I'd never been through that personally. And so to me, I'm like, oh, great. Like everything goes up and to the right. This is amazing. And it don't work like that. It don't work like that.
No, it doesn't work like that. And to quote the great Kenny Rogers, you got to know when to hold them, know when to fold down. Like it is hard to build that like muscle memory of like, okay, do I double down on this or do I take the win for what it is? He still came out great, but that's a really, really interesting observation.
Hey, I don't know if you remember this, but when we started this podcast, we entered into a social contract. I would spend time, energy, and money producing this podcast, interviewing these individuals and giving you insights into how to build, buy, start, grow your business. And you would like, subscribe, and leave me 5-star review. Now, out of that, we both get to talk to really cool people and hear really cool insights. We both get a ton of value. But I just want to help you keep your word. So would you do me a favor? Will you go leave a 5-star review for me on Apple or Spotify? It would really help. And if you want, even share this with a friend.
I think the thing that's most interesting to me is that both of these properties did well, and you learned some stuff that for whatever reason made you think, I can take this same money, put it into another market with the things that I've learned and get a much better cash on cash return than 22%. What were those things? So when you sold it, I'm assuming you took those gains, you 1031'd it into something that you thought would return a much better return.
Yeah, I think a better long-term asset too. Maybe short-term cash flow would have been same or slightly different, but long-term protections. Let's just say, hey, buying a 3-bed cabin in a very heavy 3-bed market where over a third of the supply is 3 beds. So if you just go to the Airbnb platform for that market, over 35% of the supply is a 3-bed cabin. And you're like, well, crap, this isn't good. So I think the first thing I looked at from a differentiation was, what are the supply demand imbalances just on bedroom count for this next market? And that's where I started.
This would be somebody like me. I want to skip over the learnings that you did for those first 2 cabins. I want to get to like wherever you rolled this money into. The first thing that you look at in a market is the supply demand imbalance in a market.
That's correct. So
how do you measure that?
There's a common term thrown around, the S word, saturation. And I say, that's weak if you think, oh, this market is saturated. And the reason being is bedroom counts can be saturated, product styles can be saturated, but technically there is a path to succeed in every market. It might be difficult. Take Disney Kissimmee there in Orlando, Florida, probably one of the most cutthroat markets, and your path to succeed is slim as could be. But the data will tell you if you go 10 plus bedrooms with certain features and certain locations, you have a chance to win. Now, obviously, like that's not a great recipe for success that you're already buying a 5, 6, 7, 8, like good freaking luck. So that's where we're going to start first is what's the current supply in this market versus the demand, like total nights booked for those properties. And
where do you go and look for that?
There's several different data sources. So we have a couple really big strategic ones, AirDNA and Rabu, that we'll pull from, really good data providers in this space. And when you can kind of digest those, you're like, oh my gosh, let's take another big red hot market, Broken Bow, Oklahoma. 1, 2, and 3 bedroom cabins make up 72% of the supply in that market. So you're sitting there going, Nick, like, would you buy a 1, 2, or 3 bed in Broken Bow, Oklahoma?
No.
And
no.
it's like, absolutely not.
Tell me about that 4 bed. Tell me about that 5 bed though.
That's exactly where we want to be. So you start looking at, there's not great opportunities to service the large families, multiple families, or groups of friends segment of the market. And it's underserved with supply. And those that have the supply can charge a premium because there ain't a whole lot of competition. And most builders naturally don't go build 5, 6, 7 bed spec mansions. That's not a great, there's a lot of risk from a builder if you're speccing that. 1, 2s, and 3s have multiple uses, multiple exits. They're safer, air quotes. They're cheaper basis. They're lower cost to build, and they're a lower sale price naturally. So you have more buyers who can buy that. So from a builder, are you going to go build a 6-bed, 4,000 square foot mansion cabin where you put up your own money, carrying costs, and you pray you could unload it for $1 million and change? Or are you going to go build a 3-2? You could probably sell for 6, 7, 800 grand. There's a lot of buyers for that product. Well, great. Now there's a ton of those in the marketplace.
This is probably going to sound stupid, but let me restate what you're saying. I think a lot of people look at it like me, where they're like on Zillow and they're like, oh, I could get this 2-bedroom and it's 150 grand. And I think I can make that work. I could put some money into it. And they just look at the cost side of getting into that real estate. But what you're talking about is the cost is just one equation. You've got to understand what the demand is going to be for that so that you can model what the revenue piece is going to be. Otherwise, you don't have a return.
That's exactly right. This is simplified as 2 numbers. What do you buy it for, and how much can you generate per night? There's a lot of deep analysis. There's a lot of deep analysis that goes into this, but in really everything boils down to what do you buy it for, and how much revenue can you generate? And at the end of the day, you need a spread between those 2 numbers. If there's no spread, there's no cash flow. It's very simple.
Okay, so is there a supply demand imbalance? How do you find the market in the first place? Like you said, Broken Bow, Oklahoma. Like, are there just markets that are known to be hot markets, or would I just kind of look in my own geography? Where would I start?
Without obviously the level of data access that we have, I think where I would start is, look at where do you personally go? Like, I think, unless you're just a complete outlier and you're like, hey, I'm a weirdo vacation guy, which that could be true. Where do you travel? And you got to assume there's other people that do that, number one. Number 2, there's a lot of just general theses. So let's just take things that have very sound investment thesis behind them. Hey, we want to invest near the national parks. Well, that's a pretty good thesis because last I checked, they're not closing Yosemite or the Grand Canyon anytime soon. Now, maybe they will, maybe they won't, but that's a pretty good bet I could make. So it's like, cool. Millions of people are visiting these national parks on an annual basis. There's going to be constant demand. So that's an entire investment thesis that happens. And a lot of people will buy around the country near national parks. Take another one is invest within a 2-hour drive of a major metro. So think Atlanta, DC, Manhattan, Chicago, Austin, and go, okay, what are vacation towns within a 2-hour drive of these huge population hubs? Because nobody's ever going to get tired of being stuck in their 400 square foot shoebox apartment in Manhattan and want to get away for the weekend. So why is it that the Poconos and the Catskills, which are both, hour and a half, 2 hours away, why are those popular vacation destinations? Because you got 1 trillion people in Manhattan who want to get away for the weekend. That's why. Yeah. So it's just like you're like, oh yeah, duh, that makes a lot of sense. So sometimes you don't have to overcomplicate your investment thesis. And so those are like just 2 examples that people will kind of start with. Now, should you invest within 2 hours of Manhattan, 2 hours of Chicago, 2 hours of Atlanta, 2 hours from Austin, 2 hours from San Fran, LA, et cetera? Well, that depends. How familiar are you with it? Naturally, I'm a Florida boy. Like, I know the Southeast. I've traveled to the Southeast. I kind of stayed there because it was familiar. If you live in Cali, you're probably like, dude, North Georgia, I couldn't put that on the map if I tried with some of these mountain towns. So I think, you go to where your kind of creature comforts are, and then you ultimately got to start running math. So to your point, like, sure, you can have demand, but if prices are too high, it doesn't matter. There's no profit. So once you kind of narrow down your list of markets, you have to just start running numbers. What can I buy real estate for? What can I generate in projected revenue? And is there a spread between the 2 numbers?
But what are the metrics that you use to evaluate whether or not the spread's good?
Yeah, so that's going to be tied to a couple different factors. A, your debt, and B, your operational infrastructure. So when interest rates were lower, you could get away with tighter spreads. Naturally, when interest rates are higher, as they are today, in the 6s and 7s, that spread's there. So we call it the price to rent ratio, which is just simply gross revenue divided by purchase price. So the spread today with rates in the 6s or 7s, you're going to need at least about a 15% spread. So an example of that in big round numbers here is on $1 million purchase price, you need at least 150 grand in revenue to have some spread, to have some cash flow left over.
In gross margin, you mean?
Just gross revenue. So 150 grand will be top line. And then after all expenses, you will have enough left over to generate some cash flow. If you buy $1 million Airbnb and you're only generating 100 grand, so a 10% ratio, 100 grand divided by $1 million, I could tell you that if you back out all your expenses, mortgage, utilities, toilet paper, pool cleaning, landscaping, you will have $0 left over. In fact, you will owe money every month with that spread. It's too tight. Now, there's always outliers. That's the envelope math, and it's envelope for a reason. So take a place like Texas, super high property taxes. Take a place like Florida, higher insurance. Take a place like North Carolina, cheap taxes, cheap insurance. So your spreads can be tighter when you have lower operating expenses, and they have to be a little larger in places like Florida, Texas, California, high labor, et cetera. Just because, again, those are fixed expenses that are going to hit you every month. Your tax bill, your insurance bill, the pool cleaning guy. You can't not pay those.
How do I estimate revenue? I just look at what's the average revenue around and then say, okay, of 365 days, I'm going to estimate 50% occupancy. Like which numbers do I use to plug in? Does that make sense?
Yeah, no, absolutely. So that's where those great resources, AirDNA and Rab, are going to come in handy. So what you can do is dive in there on market specific. So say you do want to dial into North Georgia, say you want to dial into, the Catskills in upstate New York. And then what you can start doing is isolating bedroom counts. You're like, hey, you know what? I think I'm going to buy a 3-bed, or I think I'm going to buy a 4, or hey, I can only afford to buy a 3 or 4. So that's the other thing. The data might say, dude, you should buy a 5 or a 6. Well, if you don't have enough cash to buy a 5 or 6, what's your next best alternative? And so once you understand what you can afford and what you're going to hone in on, then you got to look at, okay, well, what are all the other 3-beds around me generating? What amenities do they all have? What's their design style? What part of town are they located? Are they only on the north side? Are they spread out northeast, southwest, and location doesn't really matter? So all of that's just diving into the data once you've kind of narrowed in that. And so that'll give you kind of that directionally correct data that you're looking for is, okay, all these 3-beds in this part of town are generating between 70 and 95 grand in revenue. Well, you can't underwrite and say, you know what? I'm going to do 120. I'm the new best guy. Like it's just unrealistic to assume. So you need to go and say, well, if I'm only generating 70 to 95 grand on this house, will I make money? And if the answer is no, then you probably can't buy a 3-bed in that market or a 4-bed or whatever that metric is, because you won't make enough profit.
So do you just estimate occupancy based, like AirDNA will give you all that stuff? Like AirDNA is going to kind of give you an estimate of what the revenue is going to be?
Yeah, you're going to see market level occupancies. And what I always say is our occupancy is only half the equation. So it is interesting because occupancy gets measured a lot in long-term rentals, in self-storage, and in everything else. But here, I could get 100% occupancy in my Airbnb. I'll go charge $10 a night. And guess what? I'll be booked every night of the year. Now I won't make money, and that's a problem. And then the flip side is I could be very egotistical and say, you know what? I'm never letting anybody rent my place for under $300 a night. I'll probably only be 40% occupied, but I've held high on my average daily rate. So average daily rate and occupancy is what makes up revenue. And so what you have to find is what's the best blend of the two of those together. Now, a market like Michigan or Wisconsin, you're not going to roll 70, 80% occupancy, even if you tried, because it's too seasonal. Now in Florida,
oh, that makes sense.
You could run 100% occupancy, but you would be leaving money on the table, meaning you're filling your calendar for lower nightly rates than you should. That sweet spot on, like, again, very envelope math basis, it is somewhere between 68 and 78% occupancy. So if you can kind of float between that, where you don't get too much lower and you don't get too much higher, you're achieving maximum revenue. So that's what I'm saying. Like, you want to try to aim for the peak there where, again, you're occupied, but you're also charging enough that you're like, hey, this was worth it, because you have to make the two work together.
And if I go and do the math and I'm like, oh, I could generate about $150,000 using that back of the envelope, I could also say like, all right, then that means my max property price that I could pay is about $1 million. Like you're kind of like backing into where you think you could invest. I mean, does that make sense?
Exactly. And then what you'll draw is your little filter there. So again, let's go back to that Catskills, upstate New York. And you're like, okay, well, what's for sale for under $1 million in this region? And it might come back with 0 results, or it might come back with 500. You're like, sweet, I have options here. And that's how you start to learn, is this market investable or not? And, again, if you do that same example and you're like, okay, I did the math. I think realistically I can make 150 grand. So I need to buy something at or below $1 million, and 0 query results come back on Zillow or Redfin.
Not your market.
You're like, hey, I need to go to a different market. And so this becomes process of elimination and just ripping, can it work? Yes, no, cool. Go to the next one. And it's trial and error until you find markets that work, markets that have consistent inventory and consistent revenue that you can make profit.
I think one of the interesting things that I've seen is that like these short-term rentals got really big everywhere. It wasn't just coastal cities in California and Florida. It was like Michigan. All of a sudden people were buying. They're like, oh, I'm just going to short-term rental this thing out. And to your point, it's like those have very different seasonal effects. And then when more and more people start doing that, the limited inventory that was there all of a sudden expands, and you have a lot less occupancy that builds on top of it. So I've seen people kind of get in trouble here locally trying to do the STR model. I just think that's a really interesting perspective. So how does taxes play into this? Because we talked about the revenue and the cost and all that other stuff, but then like, dude, taxes are amazing. I know that's why I'm interested in it. How does it work?
Yeah. So easiest way I'll describe this, and again, not a CPA, we'll pretend to be one on TV here for a little bit today, is when you have taxes and depreciation, you have active income and you have passive income. And so active income is obvious. That's your W-2, your 1099, you're working for it. If you passively invest in something, whether that be a business or another piece of real estate, you receive passive income, that's obviously classified that way. So if you're trying to offset that income, you can only offset passive income with passive depreciation, and you can only offset active income with what is considered active depreciation. So you're like, okay, cool. Well, where do I find this active depreciation? Is it in the room with me right now?
Is he here? I did this. I sold my businesses and I was like, oh, I'm going to save on taxes. I invested in some opportunity zones and some real estate. And then the end of the year comes and they're like, okay, you owe, whatever, $500,000 in taxes. And I was like, oh, cool. Well, I have $500,000 in passive losses. So just deduct it from those passive losses. And they're like, it doesn't work like that. And I was an idiot. I should have done some more research. So to your point, where are all these active losses happening?
So in the IRS, you have 3 really basic buckets. So you have oil and gas, which I am not a Texas or Oklahomian and can't help you there. So find someone who lives locally and could get you there. So there is oil and gas investments, which can give you that. There is equipment. So if you buy equipment, which falls under section 179 of the IRS code, that will also give you active losses. The fun one is the G-Wagon. So I'm sure during COVID and on Instagram, people said, oh, you buy a G-Wagon? Because the equipment from a vehicle perspective has to weigh over 6,000 pounds. A G-Wagon, a Chevy Tahoe, a Cybertruck, a lot of strategic vehicles you saw that got purchased all qualify as that.
So weird.
Yeah, really, really interesting. And then the third bucket is short-term rentals. So I know you joked and said, oh, a lot of people say this is a passive investment. Well, the IRS will tell you, no, this is an active investment.
This is an active investment. That's interesting.
And we will give you tax advantages to prove it because we will classify your tax losses as active losses.
Is it because you're managing? Is that why it's active?
So the key term is because, and again, the only way to unlock these, you can't just buy an Airbnb and you automatically get them. You have to earn them through what is called material participation, which is in short saying, hey, I am materially participating in the business activities of the short-term rental. There's 7 different ways to qualify for material participation. So I don't know which one's the best path for you. You should consult your CPA, but it involves how much your output is in the business. You can't hire a property manager and do nothing and say, oh, I materially participated. That would kind of go against what the basic definition is. So if you achieve some of these, achievable benchmarks, again, not super impossible, and you hit material participation, you could take those active losses to offset your active income. Now let's put some real numbers behind it because that's where it gets fun. Okay. Again, I'm going to give you the envelope example here.
I'm in.
Typically, your depreciation, now that we have the big beautiful bill and 100% bonus depreciation, so you get to unlock all of it in year one, you're getting roughly 25 to 30% of the purchase price in depreciation. So again, big round numbers, you buy $1 million short-term rental Airbnb, you materially participate. You're going to order what's called a cost segregation study, which is where a fancy engineer is going to come in. They're going to assign values to every structure on the house. You don't have to do anything. And they're going to say, cool, Nick, here's how much depreciation you unlocked on this house. You give that to
because you can't depreciate the land, right? Like the land is undepreciable.
Bingo. So when you buy that property for $1 million, it's made up of 2 things, the land and the structure that sits on the land. So you can't deduct the land value. So if you invest in a high land value market, think South Beach, Miami, or Big Sur, California, those are going to get less depreciation dollar for dollar versus you buy an Airbnb in rural Vermont where the land is worth 3 nickels. You're going to get a lot of depreciation dollar for dollar. Okay. So it's like, so what I tell people is, what are you investing for? If you're investing for long-term appreciation, yeah, Miami Beach is probably better than rural Vermont.
It's probably a better bet.
If you're maximizing for tax benefit, rural Vermont is way better than Miami because you're going to spend the same dollars to buy the house, down payment, furniture, et cetera. But how much depreciation? Now, again, you don't get zero. You just get significantly less because you can't take the land and depreciate the land. You can only depreciate the structure. So that's where that envelope math, again, could be a little bit more, could be a little bit less. But if I hang out in that 80-20 portion, 25 to 30% of the purchase price is what you're going to unlock. So your $1 million Airbnb gives you 250 to 300 grand of depreciation. Let's say you and your spouse together, you guys both make 400 grand of combined household income. All right. You take your 300 grand of losses, you slap that against your 400 grand. You're assuming no other write-offs that you and your spouse have. Your new taxable income is 100K. So you put 400 grand in your pocket. That went into the bank account. You earned that from working. Doctor, dentist, lawyer, W-2, business owner, 1099, whatever you do. But your taxable income is now 100K in that example.
There's a cap on the depreciation amount, right? Isn't it $2.5 million?
Think with the big beautiful bill, it went up to about 1.25. That might be single, not married. But yeah, it's very high north.
But there's a cap of how much you can depreciate.
Correct.
Is the point. Okay. And it's not like the SBA, if I go get an SBA loan, 5 million is the limit. It doesn't matter how many businesses I buy, it's 5 million. But with this, that's on a per property basis. Like I could buy 10 properties and depreciate all 10 properties in a single year, theoretically.
Assuming you have the liquid capital, absolutely. If you can afford to buy it, absolutely. You can order a cost segregation, you can materially participate. And then when you own multiple properties, again, not a CPA, but we'll talk like one on TV, there's a term called a group election where you can put them in a group election. And in essence, instead of having to put individual hours into each of them, you're putting in hours into quote unquote your business. So if you own 2, 3, 5 Airbnbs, Now your material participation isn't, oh, well, you need to hit a certain amount of activity on every individual, but more or less how much activity did you put in the total business? So it
Combined.
allows you to kind of, in essence, put in less hours versus if you had these as all individual entities.
I don't know if you knew this. I just talked to Chris Berg, who's on my podcast, and he does car washes. Car washes are also an investment that count as active investment. I didn't realize that. But as he was talking about it, he was like, dude, it's a flywheel. I have this services business that kicks off a bunch of cash flow, and then I just funnel that into the real estate, buy real estate. So I'm building equity in the real estate, and then I use the accelerated depreciation to offset my taxes. And that money that I saved on taxes, I just put back into the business to grow the business, that then generates more cash flow that I put into real estate. Just keeps kind of spinning like that. Have you found that as well?
Yeah. So when you could take, some of these awesome opportunities, and we'll nerd out even more here. The best case scenario that you want to try to aim for is a 1-to-1 ratio. So let's just say I invest 200 grand into a short-term rental, down payment, closing costs, furniture, amenities. Okay. If I can get 200 grand of depreciation, that would be, considered a good investment. 60 to 70%. So you invest 200 grand, you get $1.60 in depreciation. That's good. It's not an amazing deal. Anything north of 1, you go get 1.25, 1.5, or 2-to-1 on your money. It's absolutely insane. You need a lot to go for you. Like I said, cheap land value. Maybe there was already furniture in there, so you didn't have to spend that money. So your out of pocket is lower. These are all things that could be cheat codes. But if you go spend 200 grand to get your short-term rental and you get 200 grand of depreciation, so you maybe bought a 650 purchase price. Let's just say you're in the blended 32 or 37% bracket, between state and federal. You're talking about saving $70,000+ in real money. So forget your cash flow on the short-term rental. When we talked about the cash flow I got on that very first North Georgia cabin, that was cash in, cash out. But we didn't even talk about the tax savings. So right now out of the get-go, I invest 200 grand into a short-term rental and I save 70 grand that I would have given to the US government. It's not optional, by the way. Last I checked, it is forced. So now I'm paying myself instead of paying the US government. I got a 30% plus return on day one, even if the Airbnb breaks even. Now, obviously the goal is to actually make money, go make 1, 2, 3 G's a month in free cash flow. But even if you didn't, I can tell you last I checked, paying the US government taxes, you get a guaranteed 0.0% return. You will never see that money again. But if you buy an asset, you pay down principal, you hold it, it grows in value. Soon you can eke out any level of cash flow, you will get a return on that money to some level.
If you buy these assets, right? If you buy real estate and you get these passive or active losses, whatever you want to call it, what if I accumulate $300,000 of active losses, but I only make $150,000 a year? What happens to the $150,000 delta? Does it go away?
No, it's the best part. You could save it for a rainy day. You could roll it into future years. So that is the best part. So, you see why 90% plus of millionaires own real estate is they're in the depreciation accumulation business. So, they have a very nice cash flowing service business, tech, hedge fund, equities that spits off a lot of cash, and that creates tax liability. So how do you offset that? You offset that with buying real estate. It's not necessarily, people don't really start buying real estate to get rich. That's not typically the route. You can do it a way quicker, way more efficient in service business, the SMB world, et cetera. But how do you keep more of what you make in those businesses is by buying real estate. And you can accelerate that tax savings by having active income. And that's where buying a short-term rental just becomes super lucrative to people.
We're not CPAs, right? We're just playing one on TV. So I'm just going to brainstorm with you here. So if anybody's listening, that's our disclosure. Don't take what we say as financial advice. I have a house that we moved from that I didn't sell, and we're renting it right now. And we just started renting it this year, and we're managing it. That's going to be an active, I guess, whatever piece of real estate that we're managing. Could I depreciate that? Or would I have to go, does that count or no?
So one of the caveats to material participation is you have to prove it is a short-term rental. And the definition, according to the government, is your average rental stay is 7 nights or less. So if you are actively managing this and someone's in there for a 6-month or a 12-month term, the average on that will be significantly more than 7. So that would just be regular depreciation, which again, you can accumulate a lot of passive losses and save those for rainy days whenever you get more passive income. But it has to be a short-term rental. And so obviously proving that, the caveat to, hey, how do I prove this is a short-term rental? Well, was the average length of stay 7 nights or less? Doesn't mean every stay, just means the average of all stays. So you could have a 90-day stay, a 90-day booking, and they get a bunch of 1 night, 2 night, 1 night, 2 night, 1 night, 2 night, checks in Friday, check out Sunday. If the average is 7 nights or less, it is classified as a short-term rental.
Jeez. Okay. What are your favorite markets right now, or favorite trends that you're seeing that you're like, hey, we got maybe a year for somebody to exploit this and take advantage of it?
Like I said, investing at the pools right now is super hot. One, couples getaways or cottages, it is a very unique trend. You can provide things that a hotel just can't, whether that's hot tubs, saunas, romantic hammocks. You're by yourself versus, hey, it's 400 square foot and I share a wall with someone else, a la hotel. So that is a strategic investment on one side of the pool. The other is 4, 5, 6 bedrooms that accommodate big groups that, again, they're not going to go rent 7 hotel rooms. And so you kind of get out of that 2, 3, 4 zone and you go to the pools. And right now what you're seeing is the outsized returns are living at the pools. The average group size on Airbnb, so the good news about them being a public company is they release their numbers. You start looking at the quarterly report. It's grown now for 10 straight quarters. How many people are in a booking? So they have all this data, obviously, firsthand of, hey, 6 people checked in here, or 9 people, or 27 people. Average total number per booking has gone up for 10 straight quarters. So what does that tell you? The puck is growing to more and more people. They're saving money. You can split the costs amongst more heads in a large group travel, and it's cheaper than a hotel. They get that together experience. So the bigger upstream you swim, you're getting paid off for because the puck is going that direction. So what we're heavily doubling down on right now is bigger properties, or again, go the complete opposite. Very customized romantic experiences for, 1 bed couples, because again, no builder is building a 600 square foot, little treehouse yurt, cottage thing. They're not building those. So if you can get your hands on one or build one yourself, you've got a great opportunity to add nice little fire pit, nice little hammock, maybe the outdoor shower, all the little romantic things that you do. People are like, well, what's my alternative? My alternative is to pay $200 to go stay at a hotel with, powdered egg, continental breakfast and a, carpet and share a wall. Or I could pay a little extra. I could pay $300 a night and we got 1 acre by ourselves in the woods. It's an easy decision 100 out of 100 times. And that's the direction that honestly, like, we're doubling down on right now, is go super big or go super romantic and super small.
Okay. Last thing. For somebody who's just starting this journey, what's like the one piece of advice you would have known up front? And it could be something we've already talked about, but like, what do you think is the most important thing when trying to make money with short-term rentals that you would tell someone just starting out?
Invest where it makes the most sense for where you are today, not necessarily for where you're at. If you have a large tax problem today, you're not necessarily trying to chase, oh, can this Airbnb make $2-3 grand a month? You're like, hey, how do I not pay $80,000 in taxes? On the flip side, maybe you are miserable at your W-2. Maybe you want to retire your spouse and you're like, hey, like, sure, I'm going to get depreciation, but maybe I'm not as hyper efficient. But how do I buy a glorified ATM machine that can spit out 2, 3, 4 G's a month, that I can stack 1 or 2 of those to retire my spouse or have her cut back? And so whatever your strategy is, you're going to definitely pick a different market based on whatever that thesis is. And I think people get too caught up in, they're like, well, yeah, like, I like my job, I just pay a lot of taxes. Well, you don't need to go chase the high cash flow, less tax efficient markets. Or on the flip side, it's the opposite. So to me, I say, solve what's in front of you today. Now, if sure, you don't want to pay taxes today and that's the first short-term rental, that doesn't mean the second one's not allowed to be an ATM machine where you chase yield. But I think people get too caught up in, oh, well, if I'm going to buy 2, 3, 4 of these, they all have to be cash flow forward. They all have to be tax efficient. And I say, solve the problem that's in front of you today, because you and me and everybody else, we have a finite amount of liquid capital. So again, if I can only buy 1 for right now, if you're fortunate, you can buy 2, that's great. But if you can only buy 1, solve the problem that's in front of you today. And then a year, 2 years, wherever you're on to your next one, maybe you don't have a tax problem because you had another investment that helped that. Or maybe you do want the wife to cut back at work because you're tired of her slaving. Solve that problem then, and you're allowed to buy 2 different properties, which in 2 different markets with 2 different strategies. That's okay. So it's a mistake I see people make is when they try to overthink this investment. I said, dude, like Nick, solve the problem that's in front of you today. If you have a tax problem, let's solve that efficiently. If you're miserable at work and you want to quit or the spouse or whatever, like let's go try to find an ATM machine that can spit out cash for you.
Is that why you started your second business, right? Because you raised money, you own these Airbnbs, and then you started STR Search. Is it because there are people like me who are like excited at the prospect of real estate and short-term rentals, but then get quickly overwhelmed with like, oh my gosh, that's too much data and research that I have to go and do. So just take my money, Taylor, just tell me where to go invest. Is that like kind of the thesis behind your new business?
Yeah, that's really what we started STR Search for was, hey man, we have 4 full-time data analysts. We've studied 359 markets. We look at 200-300 Airbnbs a day, every day, all day. Like you don't have to guess where is a good market. You don't have to guess where the most depreciation is. You don't have to guess. We can just present data. And so we'll come in and we'll be the data guys in the background. But, ultimately it's your car. You're driving. It's your house, your money. You get all the upside. I'm just going to make sure you don't crash the car or hit the curb by trying to do this yourself. Because unlike equities, it's not, oh, I bought Apple stock, it went down, I sold it, I lost $50. Like you buy and sell real estate, you could lose 25, 50, 100 grand by making a bad decision.
Bankrupt.
That's what we want to avoid with clients is, hey, why don't we make a high ROI decision? Because this is where the real tax problem gets people in trouble. It's like, oh, cool, I bought an Airbnb and I saved 50 grand in taxes. But if the house loses 25 grand a year in free cash flow, that net savings, you're upside down in 3 years now. So now your tax benefit's gone because the house itself can't sustain it. And that's where we say is, hey, yeah, let's get the tax benefit, but let's also make sure there's enough cash flow on the back end that this is a good long-term hold for you and your family.
I see a lot of people who are trying to over-optimize tax so hard that they end up screwing themselves on like a real business or short-term decision. Like optimizing for taxes is important, but that shouldn't be your sole focus. I totally agree with that. Well, cool, man. Where's the best place for people to come find you? Is that strsearch.com?
Yeah, head out to STR Search, Calendly's right there, grab time. Happy to talk about your individual situation and, we'll show you what we could do. And if there's help needed, great. If not, man, like we're just a bunch of data nerds and we can dump a bunch of short-term rental Airbnb data on you. And we love this shit because it's all day, every day, man.
I love it. All right, man. We'll talk soon.
All right. Hopefully you liked that episode. And if you've made it this far, you're either really committed or you're stuck doing yard work and you can't actually skip on your phone. So while I have you, the show is growing, but I have a favor to ask of you. Will you please help me grow the show? I want to reach more people. There's a couple things that you can do. Like and subscribe is the simplest thing. Obviously, you want to get notifications for when the next episode is coming out. But if you go the next step, will you leave me a review? 5-star on Spotify or Apple. What that does is it tells the algorithm that, oh, hey, this is a high value podcast because more people are leaving reviews for it, and it then pushes it out to more people. So that's why when people are like, will you like and subscribe and put a 5-star rating? It's not just to make themselves feel better. It's actually to get more exposure for the show. So if you do that for me, I would greatly appreciate it. And I'll see you next time.